Does making money every single day sound appealing? Well, it did to me too back when I got sucked into day trading. But instead of profits, I lost money into the thousands. And after months of chasing the right strategy, I started to wonder if day trading was just a scam with cunning branding. That was until I discovered another system that took me from losing money to making consistent profit. A system that didn't fix my day trading, it replaced it altogether and makes more money with less work. A method built on long-term momentum, no noisy charts, no constant screen watching, no more staring at red numbers. And it's averaged 30% a year without the burnout. So if you're still asking, can I make money every day? Well, you're asking the wrong question. I'll show you why what you're doing doesn't work. And by the end, you'll know how to make consistent profit using a simple strategy that's quietly outperforming day traders every single year. But before we get into the step-by-step method, let me break down why this approach isn't luck, nor complex algorithms. It's just simple maths. I'll show you exactly what that looks like with real trades on a real stock. We'll use Microsoft right after the COVID-19 crash in 2020. Markets were recovering, volatility was high, and this is the kind of environment day traders love because the swings feel like opportunity. So let's assume a day trader caught 10 of those swings, and let's assume each trade made money. 100 shares were bought for each trade. They would have made decent gains, actually an average of 7.25% per trade. And over all 10 trades, they'd walk away with just over $16,000 in profit. Not bad, but let's look deeper. That's 10 trades. Close one, open another. 20 round-trip fees for buying and selling the shares. 10 emotional roller coasters. 10 times trying to guess when to get in and when to get out. And for what? Now, I must stress that this assumes all 10 trades are winners, which is very unlikely. There will be losers, and so the profit will be less than the 16K, realistically speaking. Now, compare that to a trend-following system, one that only took 4 positions over the same period. No guesswork, no micromanaging, just riding the larger move. The result? Only 4 positions running simultaneously, side by side, not 10 positions where you close one and then open the next. 8 fees for buying and selling as only 4 positions, not 20 fees with the 10 positions. Less effort, less screen time, and a total profit of nearly $40,000 with an average return of 46.8% per position. Smart, right? Now, unlike with day trading where tight losses are commonplace and getting whipsawed out of positions is the norm and why losses rack up, our stop losses are wide, so none of the 4 positions would have been stopped out for a loss. I'll show you how this looks on the chart shortly. So, as you can see, $23,694 more profit. Same stock, same period, way less stress, and almost 2.5 times the return. This isn't a cherry-picked example. It's the repeatable hidden maths that you can apply to multiple winning stocks simultaneously, called a portfolio. Most traders never think to calculate. Now, executing this investment was simple. So how did we do this? Most traders try to time their entries based on short-term moves, chasing patterns, reacting to news, or jumping in after a big green candle. That's why they miss the real opportunities. We do it differently. Now, before we ever touched the Microsoft trade, we zoomed out, way out, and started with the monthly time frame. So let's have a look at this on the charts. Now, so this is the monthly time frame of Microsoft, and it's this period here where we have the impact from COVID-19. Now, even though the stock dropped 30% during the COVID crash, the bigger picture was still very much intact and actually very, very clear, crystal clear. The long-term trend was still very much bullish. And that decline, well, up close, it looked big and scary. But on the monthly time frame, we can see that it was just a correction in an otherwise strong looking bullish long-term uptrend. And if you've studied markets for a while, you'll know global events like COVID-19 usually create temporary disruptions and then get absorbed into the established bull trend. The trend tends to continue, and these events look like a blip on the monthly time frame. And we can see just that. This period of COVID-19 looks like a tiny blip in the overall bull trend. In fact, the trend has just continued to gain momentum since COVID-19. So the real question wasn't should we buy, it was when. That's where the weekly time frame came in. Most people use moving averages wrong. We don't. Let's switch to the weekly time frame to have a look. Now, this is the weekly time frame of Microsoft. The black line is the 200 simple moving average, and the orange line is the 50 simple moving average. We've got both of these plotted on the weekly time frame. And during COVID-19, which is this area here, what we saw ahead of time was actually quite powerful. Now, if we look back in the history of Microsoft, we can see that in 2016, it used the 50 simple moving average as support. It bounced off it, came back in 2018, used it as support, bounced off it. And then again, during COVID-19, we saw it come to around the 50 simple moving average. And so this was our sign that we could potentially see the end of this correction. And in fact, it did start stalling at this area right here. What happened in more detail is that it dipped below the 50 simple moving average, started stalling, and then began creeping back above the 50 simple moving average, showing early signs of strength. That was our first sign of the end of the COVID-19 crash and a continuation of the long-term bullish trend when the price of Microsoft dipped below the 50 simple moving average and then moved back above it. But we still didn't enter there because we don't trade guesses. We wait for confirmation. Our entry trigger was a break and a close above the previous all-time high set in February 2020. So when the price of Microsoft reversed, gathered momentum, and broke above the previous all-time high of February 2020, which was around June of that same year, that was our trigger to potentially start looking to enter into Microsoft. And we didn't stop there. To tighten the picture even further, we dropped down to the daily time frame. So let's move down to the daily time frame. So here we have the daily time frame of Microsoft, and we looked at price action in relation to the 20, the 50, and the 200 simple moving averages. And it was in June where our entry was met that we can see that it was trading above the 20, the 50, and the 200 simple moving averages. The 20 simple moving average is the blue line, the orange is the 50 simple moving average, and the black line is the 200 simple moving average. What we have here is alignment across all three time frames, and it was time to pull the trigger. All the signals were aligned. Monthly trend up, weekly bounce of support, all-time highs, daily momentum kicking in. That's when we made our move. And looking at the daily time frame, we can see how well the stock performed from our entry, climbing from around $200 all the way to $340 before the correction of 2022. Our system told us exactly when to enter the trade while everyone else was still second guessing the crash. Once we're in the trade, the next challenge is staying in long enough to capture the full move. Most traders exit too early. So how do we avoid that? Take Microsoft trade as an example. Over that 1 year run, there were multiple moments that would have tempted most traders to get out. The price dipped a few times. It moved sideways for weeks. There were red days that looked worrying, especially to someone watching the chart every hour. Most traders would have seen those moves and said things like, it's rolling over, or I don't want to give back my profits. So they would have exited, not based on structure, but on emotion. A big mistake. We didn't do that. And the reason is simple. We follow a rules-based method that removes the guesswork. First, we use a structural trailing stop loss. As long as the stock is forming higher highs and higher lows, there's nothing to do. We trail the stop loss up below each key support level, locking in profit without choking the trade too early. The only time we consider exiting is if price breaks below a prior low. That's our first sign that the trend may be ending. Second, we use a trend filter that tells us whether the broader bias is still bullish. If the bars are green, the trend filter is in play and we stay in. If they turn gray, that suggests a short-term correction, so we proceed with caution but remain in the trade. It's only when they turn red that we consider reducing or exiting our position, because that shift suggests the bias has changed from bullish to bearish. What beginner traders and day traders often get wrong is that they treat every dip as a warning. They're not used to letting a stock breathe, so even a standard pullback looks dangerous. But a smart money investor sees it differently. Not every red candle is a reason to panic. By following structure and letting the system lead, we stayed in Microsoft while it continued climbing for months. No guessing, no reacting, just responding to clear signals. Staying in an investment, even when it feels risky, is what creates outsized profits. Now, of course, eventually every trend ends, and when that time comes, we don't guess or hope. I'll show you how we exit with profit. We manage our exits with the same discipline we used to enter. Okay, let's switch back to the chart and have a look at Microsoft on the daily time frame. So here is Microsoft on the daily time frame. It was around this area here in June of 2020 when our criteria aligned across the monthly, weekly, daily, and we entered our positions. What we could see from that point was that price had been climbing steadily to the upside using the 20 and the 50 simple moving averages as an area of support on the daily time frame. So every time it came around these moving averages, we'd see a bounce to the upside. Same here, a bounce to the upside. Again, same here, a nice bounce to the upside. Again here, a bounce to the upside. So the 20 and the 50 simple moving averages were essentially acting as stepping stones, guiding the uptrend higher and higher. Now, by late 2021, we could see that the momentum was fading. First of all, it went into this sideways period, and then the stock broke out to the downside and started forming lower highs, which told us that strength behind the move was weakening. Then it broke below key support and dropped beneath both the 20 and the 50 simple moving averages. So this whole support zone was broken and we started seeing weakness back towards the 200 simple moving average. This is a clear shift in trend structure. This wasn't just noise or a small correction, it was a break in behavior. Now, in addition to that change in trend behavior and a break in structure, we were also watching the calendar. This is an additional filter we use. Most of the trends we ride tend to last just over a year. By this point here, Microsoft had already exceeded that time frame, which made us even more cautious. So with both structural and timing signals lining up, lower highs and a break of support, we didn't wait. We tightened our stop loss just below the key level at $316.29 and exited the investment with the majority of the move locked in. No hesitation, no hindsight, just a clean, rules-based exit, exactly as the system is designed to do. Our exit strategy captured far more profit than any day trader by staying in longer and exiting with precision. So now you've seen how much profit day trading leaves behind. The real question is, how do we find the investments that make 30% a year? Click here to watch the step-by-step process we use to spot high probability stocks before the big moves happen.